The invention of digital assets can be traced back to 2009 with the creation of Bitcoin, the first decentralized digital currency. Bitcoin was invented by an anonymous person or group of people using the pseudonym Satoshi Nakamoto. The idea behind Bitcoin was to create a digital currency that is not controlled by any central authority or government. Bitcoin's success paved the way for the creation of other digital assets, such as Ethereum, Ripple, XRP, XLM, XDC, Hedera, HBAR and Litecoin. These digital assets expanded the use cases of blockchain technology beyond payments and enabled the creation of decentralized applications and smart contracts. As the popularity of digital assets grew, so did the number of players in the industry. Today, there are various centralized and decentralized players in the digital asset space, including exchanges, wallet providers, miners, developers, and investors. Some of the key players in the industry include Binance, Coinbase, Kraken, Bitmain, Consensus, and Grayscale. In recent years, digital assets have gained traction as an alternative to traditional currencies and investments. Digital assets offer several advantages over traditional assets, including faster and cheaper transactions, lower fees, and increased transparency. They also provide investors with new opportunities for diversification and access to previously inaccessible assets. One of the most significant use cases of digital assets is cross-border payments. Cross-border payments are currently slow, expensive, and subject to high fees and volatility. Digital assets can solve these problems by enabling instant and low-cost transactions across borders. In the future, digital assets could become the primary form of currency in the global economy. They could coexist with traditional currencies and enable seamless person-to-person and institutional transactions. Digital assets could also become a key tool for governments to manage their monetary policies and reduce the risks of financial crises. Governments and regulators are still grappling with how to regulate digital assets, and some countries have banned their use altogether. Digital assets are also prone to hacking and fraud, and their current transaction capacity limits their widespread adoption. In conclusion, the invention and evolution of digital assets have revolutionized the way we think about money and value transfer. Digital assets have the potential to become the future currency, enabling faster, cheaper, and more transparent transactions across borders. However, their widespread adoption requires overcoming several challenges, including regulatory uncertainty, security risks, and scalability issues. Advantages of digital assets. Faster and cheaper transactions. Digital assets enable instant and low-cost transactions compared to traditional payment methods, such as wire transfers and credit cards, which can take days to settle and charge high fees. Increased transparency. Digital assets operate on a blockchain, a distributed ledger technology that records all transactions and enables anyone to track them in real time. This increased transparency reduces the risk of fraud and increases accountability. Access to previously inaccessible assets. Digital assets provide investors with new opportunities to invest in previously inaccessible assets, such as real estate, art, and commodities, through tokenization. Diversification. Digital assets offer investors a new asset class to diversify their portfolios, reducing the risks of concentration in traditional assets. The future of digital assets is likely to be shaped by several factors, including regulatory developments, technological advancements, and market demand. As governments and regulators work to create a regulatory framework for digital assets, their adoption is likely to become more mainstream. Technological advancements, such as the development of scaling solutions and improved security measures, will also play a critical role in the future of digital assets. These advancements will enable digital assets to become more scalable, secure, and user-friendly, making them more accessible to a broader audience. Finally, market demand for digital assets is likely to continue to grow as investors and merchants seek faster, cheaper, and more transparent transactions. As more people adopt digital assets, their value is likely to increase, making them an attractive investment opportunity. In conclusion, digital assets have come a long way since the creation of Bitcoin in 2009. They have the potential to become the future currency, enabling faster, cheaper, and more transparent transactions across borders. While there are still challenges to overcome, such as regulatory uncertainty, security risks, and scalability issues, the future of digital assets looks promising. Now, let's discuss the key players in the digital asset space. Bitcoin. Bitcoin is the first and most well-known cryptocurrency, created in 2009 by an unknown person or group using the pseudonym Satoshi Nakamoto. It operates on a decentralized blockchain and has a limited supply of 21 million units. Ethereum. Ethereum is a blockchain platform that enables developers to build decentralized applications, or dApps, on top of its blockchain. It also has its own cryptocurrency, Ether, which is used to pay for transactions on the platform. Ripple. Ripple is a blockchain platform that enables banks and other financial institutions to settle cross-border payments instantly and cheaply using its native cryptocurrency, XRP. Binance. Binance is a cryptocurrency exchange that has quickly become one of the largest and most popular exchanges in the world. It offers users access to hundreds of different cryptocurrencies and has its own cryptocurrency, Binance Coin, which is used to pay for transactions on the platform. Coinbase. Coinbase is a cryptocurrency exchange and wallet provider that is popular among retail investors. It offers users access to several different cryptocurrencies and has a user-friendly interface that makes it easy for beginners to buy and sell digital assets. In conclusion, digital assets have come a long way since the creation of Bitcoin in 2009. They have the potential to disrupt traditional financial systems and to provide users with faster, cheaper, and more transparent transactions. While there are still challenges to overcome, such as regulatory uncertainty, security risks, and scalability issues, the future of digital assets looks promising. As we move forward, we can see digital assets playing a major role in the global economy. The rise of digital assets is driven by several factors, including the need for faster and more efficient payment systems, the desire for more privacy and security, and the growing interest in alternative investments. One of the key advantages of digital assets is their ability to facilitate cross-border payments. With digital assets, it is possible to send money anywhere in the world instantly and at a low cost. This is a game-changer for individuals and businesses that need to make international payments regularly. Furthermore, digital assets are also attracting the attention of large institutions, such as banks, hedge funds, and pension funds. These institutions are recognizing the potential of digital assets as a new asset class and are beginning to invest in them. This is driving demand and increasing the legitimacy of digital assets. In addition, the rise of decentralized finance, DeFi, is also driving the growth of digital assets. DeFi is a new ecosystem of financial applications built on blockchain technology that enables peer-to-peer transactions without the need for intermediaries. This has the potential to disrupt traditional financial systems and to provide users with more control over their finances. As we look to the future, we can see digital assets playing a major role in the global economy. They have the potential to transform the way we transact, invest, and interact with financial systems. Regulatory uncertainty is one of the biggest challenges facing the digital asset industry. Governments and regulators around the world are still grappling with how to regulate digital assets, and the lack of clarity is creating uncertainty for investors and businesses. As more users and institutions adopt digital assets, the blockchain networks that support them will need to scale to handle the increased demand. In conclusion, digital assets are an exciting new asset class that has the potential to transform the global economy. They offer faster, cheaper, and more transparent transactions and are attracting the attention of both individuals and institutions. However, the industry still faces challenges and risks that need to be addressed. So, let us dive deeper into Ripple and XRP. Ripple is a blockchain-based payment protocol that aims to enable fast, secure, and cost-effective cross-border payments. It was founded in 2012 by Chris Larsen and Jed McCaleb, and it has quickly become one of the most prominent players in the digital asset industry. The Ripple network operates on a decentralized blockchain, but unlike many other cryptocurrencies, it is not designed to be a decentralized currency. Instead, Ripple's focus is on providing banks and other financial institutions with a fast and efficient way to settle cross-border payments. The native cryptocurrency of the Ripple network is XRP. XRP is used to facilitate transactions on the Ripple network, and it has several advantages over traditional payment methods, including speed. XRP transactions can settle in just a few seconds, compared to traditional cross-border payments, which can take several days. Cost-effectiveness. XRP transactions are much cheaper than traditional cross-border payments. This is because XRP transactions do not require intermediaries, such as banks or payment processors, to facilitate the transaction. Scalability. XRP can handle a high volume of transactions, making it a good option for large institutions that need to process many transactions quickly. Ripple's technology has been adopted by several banks and financial institutions around the world, including Santander, American Express, and Standard Chartered. Ripple's payment protocol is designed to be interoperable with existing payment systems, which makes it an attractive option for these institutions. However, Ripple has faced several challenges in recent years. XRP has been the subject of several lawsuits by the U.S. Securities and Exchange Commission, SEC, which has accused Ripple of conducting an unregistered securities offering. This has created uncertainty for investors and has made it more difficult for Ripple to expand its business. Despite these challenges, Ripple and XRP remain a significant player in the digital asset industry. They offer a fast and cost-effective way to settle cross-border payments, and their technology has the potential to disrupt traditional payment systems. While it is impossible to predict the future of any digital asset with certainty, it is true that a win or declaration of positive clarity in the SEC lawsuit could have a significant impact on Ripple and XRP. One reason for this is that the lawsuit has created a lot of uncertainty for investors and has made it more difficult for Ripple to expand its business. If the lawsuit is resolved in Ripple's favor, this could remove the uncertainty and provide a clear path for Ripple to continue its growth. Furthermore, a win or positive clarity in the lawsuit could also lead to increased adoption of Ripple's technology by banks and financial institutions. Many institutions have been hesitant to adopt Ripple's technology due to the uncertainty created by the lawsuit. If this uncertainty is removed, more institutions may be willing to adopt Ripple's technology, which could drive demand for XRP. If demand for XRP increases, this could lead to an increase in its price. It is possible that the price of XRP could go up significantly if the lawsuit is resolved in Ripple's favor, although it is impossible to predict by how much.